Hello and welcome to an exclusive Next Level Mastermind presentation. I'm your host today, joined by my rock star co-host, Fletcher Wheaton. You know what? I think I just said I'm your host and I didn't say my name. My name is Adam Carswell, joined by my rock star co-host, Fletcher Wheaton. Fletcher is the founder of Cabo Key, which is the #1 real estate investment firm in Cabo, Mexico. Really happy to have you guys here with us today. Super excited for this presentation. Going to get a ton of value out of it. Thank you for investing your time with us. To kick things off, I was just in a Russell Brunson webinar, and I don't know how, I've done a handful of webinars over the past few months, and I don't know how I always forget to do this. So I'm stealing this one from the guru himself. Everyone who's tuned in here live today, go ahead and comment your name, say hello, say where you're tuned in from. Let us know you're listening. Let us know what you're excited to talk about. That chat box is going to be the place of action today as we move through this presentation with our guest, Akhil Patel, which I'm going to tell you about Akil here in a moment. But first, before we get into that, I do want to flip it over to my co-host, Fletcher Wheaton. And Fletcher, if you could just also give a little bit of background on yourself, where you're calling in from today, and what you're looking forward to getting out of today's presentation.
What's up, guys? Fletcher Wheaton here. Thank you, Adam. Really excited. And I want to keep this short because I want to make sure we have enough time. But really, I don't know if you can see it here, but The Secret Life of Real Estate and Banking, this book is what really got me and Adam to go down the rabbit hole and get in touch with Akil. And I've listened to quite a few things of him, and I'm really excited to get this going today.
Definitely. Yeah, to kind of connect the dots here too, we got to give a proper shout out to our friend Adam Gower, who had someone who Akil works very closely with, Phil Anderson, on his podcast. We reached out to Phil. Phil handed us off to Akil, and I think it's just becoming a beautiful relationship for everyone involved here now. So a little bit more context. Actually, you know what? If you guys are tuned in here on the replay, I don't know if I said this, but be sure to subscribe and check out all the links in the show notes today. And it's just a good way to follow up and keep in touch. And if you're tuned in on the Dream Chasers platform, be sure to rate, subscribe there, and also check out the video replay. So speaking of the video replay, today's presentation is real estate really on a predictable 18-year cycle? It's, I think, an idea most of us have never heard of before. I know, at least before meeting Akil and Phil Anderson and talking to Fletcher and Adam Gower about it, I had no idea. And so once you start going down this rabbit hole, you start to notice some really powerful things. And we're, again, grateful for Akil's dedication to studying this theory, this cycle. It's really mind-blowing once you see just how predictable it is, looking at the metrics that we're going to take a look at here today. So, ladies and gentlemen, a little bit about Akhil Patel. The legend himself is here. He's going to break down this question for us. As I mentioned, Akil is one of the world's leading experts in economic, financial, and property cycles. He has been working with Phil Anderson, who he referenced, for over a decade to produce unique research that combines an in-depth understanding of business, real estate, and stock market cycles. Akil has not one, but 2 master's degrees, one in finance and one in public policy. And he currently serves as the director at Property Share Market Economics. He's going to go through a brief presentation with us here today because we're really excited to get some questions going his way. And so here we go, Akil. The microphone is now yours.
Well, thank you very much, Adam and Fletcher, for that lovely introduction. I should say that the book, The Secret Life of Real Estate and Banking, which I read about 2009 or 10, which changed my life, is by my very good friend, Phil Anderson. And for anyone with even a passing interest in real estate, I think it's a must-read book. But even if you're interested in kind of the economy or the ups and downs of economic life, it's also really really important. I'm just going to do a very brief presentation. I say brief, I mean, I do tend to talk a lot about real estate because it's a passion of mine. And so if I'm taking too long and you want to get questions, just tell me to shut up. And I'm more than happy to stay as long as you need for questions. So let me just share my screen. So I'm just going to give you a very brief background in kind of the real estate cycle. Just so that we're all on the same page in case you haven't had a chance to read Phil's work or kind of get familiar with the topic. So, well, I mean, 2020, I suppose, has been quite a year. I think it's fair to say. I mean, I've heard the word unprecedented used an unprecedented number of times, shall we say, in relation to what's going on. As someone who's a market commentator and speaks at events and podcasts and for various investor channels, the question that I've had most often, right from February onwards was, what the hell is going on? What's going to happen? Are we on the brink of another collapse? Is the economy ever going to recover? What's going to happen next? And I have a lot of sympathy with those questions because in 2008, which is when I really started this process of trying to understand the ups and downs of the economy, I had those questions myself. And the reason that I think I did, and I'm sure if you were investors at the time, you had the same sorts of uncertainty, was because we spent the year from about the year 2001 onwards telling ourselves that actually, macroeconomic volatility, as this worthy gentleman on the screen did as well, so that was declining. And in fact, in some ways, we've moderated the boom and bust cycle. Now, it's very easy for us to laugh now and say, well, he didn't really know what he's talking about. But, we genuinely, as investors, believe that. He made that statement, I guess, at a speech at some Federal Reserve event in 2004, and he was proven right for at least 3 years. It wasn't until late 2007, early 2008 that the entire thing came crashing down. But crashing down, it did come. And so by October of 2008, he was forced to say that September and October of 2008 was the worst financial crisis in global history, including the Great Depression. Now, Ben Bernanke is actually a very keen student of financial history. And so for him to make a statement like that is not a glib off-the-cuff remark. I actually happen to disagree with that statement because if you do look, in fact, at previous history, the boom and bust cycle has been going on in the US and the UK, the two countries for which there's the most data and have had the most political stability for well over 200 years. And some of the previous crises during those 200 years have been really quite fierce. But nevertheless, it seems to me that what people in positions of authority have really missed is an understanding of how the rhythm works and, essentially what has happened in previous episodes, and therefore, then giving us the opportunity to understand what's going to happen next. So this kind of uncertainty about, what's going on in 2008 led me on this kind of journey. And it was actually quite personal for me because in 2008, my family's business, we were in pharmaceutical wholesaling, suffered a pretty severe couple of years. And I mean, if there's ever any industry that should be relatively immune to a recession, it would be companies that are selling pharmaceuticals to independent pharmacies, which is what my family's company does. Because if anything, people get more sick during a recession because of stress and so on. But what happens is that you have a full-blown banking crisis, and banks call in their loans and send small and medium-sized enterprises to the wall in an effort to kind of shore up their balance sheets. And the reason that I was quite concerned that no one was really helping me understand what was going on was because my family's business suffered something fairly similar in the early 90s, 18 years prior to that. And, that was, an episode where we had some financial difficulties, couldn't get a bank loan, and it had been preceded by a property boom in the 80s. And so I was saying, well, these two episodes seem to me to be pretty similar. Why is no one making the link? And so I started doing a bit of digging around, and I thought, well, I'm going to try and understand what's going on. And then I'm going to try and develop a body of knowledge such that the next time this thing happens, my family won't be caught unawares, and I'd help investors to be prepared as well. And so I came across this book called The Power in the Land. And what was really interesting about this was it correctly predicted the early 1990s economic recession, which was, we don't think of it as being particularly severe now, but if you were going through the early 90s, I mean, particularly in certain sectors, and certainly real estate was actually quite a significant economic episode. The thing is that the author, Fred Harrison, had predicted that recession in 1983, which is when he published the book. And he had discovered this 18-year rhythm, which initially had been researched by a Chicago economist called Homer Hoyt in the 1930s, using data on land development in the city of Chicago. And so I thought, well, this is really interesting. I want to find out further. And it was not so long afterwards that I came across the book that Fletcher mentioned at the outset, The Secret Life of Real Estate and Banking, by my friend Phil. And he basically, I didn't know him at the time, he's now my friend. He basically charted the course of this 18-year cycle in the US from 1800 to the present day, and then analyzed each episode in fairly significant detail and was able to point out the similarities between each of the episodes. And essentially what he found going through the history was that the US in 1800 started selling off the public domain. So, I mean, you're probably more familiar with American history than I am. But in those days, you would go off into the frontier and you would, if you wanted to claim title to a piece of land, you would go to the local title office and say, I want to purchase title to, that 160-acre plot by that river, or, with these dimensions and these coordinates and so on. And the history of land sales shows that, things used to proceed fairly sort of steadily until about 10 years in, you get a massive crescendo in activity in land sales. And this is the primary market, by the way. So this is direct sales from the government. So behind this, there would have been a secondary market with a lot of further sort of activity. And once you got to a peak, then there would be a subsequent massive fall off in the activity in the land market, and also an economic recession. And so the first one was in 1818, and then things sort of went nowhere for about 10 years or so. And then you had a massive build up and massive crescendo of activity into a peak in 1836. And then the recession of 1837 was a proper first full-blown depression that the United States experienced. But things recovered, as they always do, and they went along again until another peak 18 years later in 1854. You then had, the turbulence of the 1860s, and you got a peak in 1869 in terms of land sales, but the recession didn't actually take place. And that was also a significant depression in 1873, 19 years after the peak in 1854. And then things recovered. You got a peak in 88, 19 years after 1869, and in 1908. So for the first sort of 100 plus years of US history, you were finding a very repetitive, regular rhythm of economic recovery, things going steadily, things then starting to go over the top, this massive boom, a subsequent peak, and then crash, an economic depression, and then things starting all over again. And the distance between each peak was on average, and a very regular average of 18 years. So that was quite interesting. What Phil did was then, because after about 1920, there was no more kind of land sales. The public domain had been pretty much sold off in the US. But if you subsequently look at 20th century history, you find indeed that this 18-year rhythm continues to exist. Now, the interesting thing about the 20th century is that economic history was effectively suspended during the two world wars. And that, I think, has blinded people to the rhythm. But indeed, after 1955, things recovered in the 50s and 60s and were actually looking rather promising. And then you got a massive boom in the late 60s into a peak in the early 70s, and then a major crisis. Now, the US economy was decidedly going into recession beyond that. And this is even before what is now known as the oil shock, and is blamed on the subsequent problems of the 1970s. But actually, it was simply the real estate cycle reasserting itself. And then the geopolitical problems were on top of that. But then things recovered into 1980. And then we get to the 1990 recession, which Fred Harrison predicted. And then, of course, the global financial crisis 18 years after that in 2008. I think what we can say with subsequent history is that the cycles now have become global. So whereas in the UK and the US, you saw them on average in 18 years in the 19th century, other countries were, either colonized or not part of the global trading system or under communist regimes and so on. From about 1955 onwards, a lot of the present countries are in their current form, emerged, and they also themselves have started to display this 18-year rhythm in sync with principally the United States. And so the Eurozone countries, the countries of Northern Europe, Japan, which of course, wasn't a major country until the 1950s, Australia, Canada, and so on. Now, that's all very well, 18 years. I think the history there is particularly strong, but once you start to analyze each episode, and I'm going to be very brief, we can go back to some of these questions, is, what happens within each year, 18-year rhythm? And there is indeed some regularity. So what it starts to happen is you have the start of the cycle, everyone is very worried about the previous crisis re-emerging and so on. You spend all that worry looking backwards, but what you tend to find is that you get around roughly a 7-year expansion, which kicks off the next cycle. And then you tend to get in the middle of that expansion. So the overall expansion lasts a bit longer, a mid-cycle recession. And when you get to the mid-cycle recession, you often find that all the worries about the financial crisis re-emerging and a major depression on the cards and a property collapse, all those fears come back out. But the mid-cycle recession tends to be a lot less severe than the crisis that you see at the end of the cycle. And it tends to be relatively short in relation to the other recession. And that in itself then leads into the second half of the cycle. And this typically is the much bigger, more bullish half, and particularly the final 2 years of that. This is where you've had, so by this point of the cycle, you've then had almost sort of 12 to 13 years of expansion. Okay, there has been a mid-cycle slowdown, and things are starting to get really, really kind of bullish, and people start to take this trend here and extrapolate into the future, and everyone is competing to get into assets and to buy what they can and buy real estate and speculate and borrow too much because bank credit is very freely available. And then you inevitably get around 14 years after the start of the cycle, a peak, and then a subsequent recession. And because this recession, going back to the history of the US in the 19th century in the land sales, because that recession involves a falling land or property or real estate market, it brings down the banking system. And this is why the recession at the end of the cycle is much more severe, because all of the leverage within the system has to be unwound, and it takes a long time for that to happen before the next cycle can take place. And on average, it's about a 4-year process. But if the economy doesn't act quickly enough, that process can take a bit longer to play out, as we've seen with, say, Eurozone countries after 2008. So that's kind of the cycle in a nutshell, the sort of 18-year process. It's an economic cycle, even though it's based upon this kind of land cycle. What I've done here is I've taken US stock market data back to 1800. I've cut it up into 18-year segments, and I've averaged it together, and you see something which looks suspiciously like my relatively basic illustration of the cycle. You get things recovering slowly, then you get an expansion to the first half. For the 18 years, you get a mid-cycle slowdown. Sometimes the stock market goes sideways for a year or two. Sometimes, as it did in 2001, it comes down very significantly, but then that sets itself up for the second bigger half of the cycle into a peak and crash, and the median fall in the Dow Jones at the end of the cycle is 48%. So it is a major stock market episode that takes place at the end of the real estate cycle. So this is really what we're talking about, an economic and financial cycle that happens to be founded upon what's going on in the land market. So I suppose now the $1 million question is, where are we currently? So I mean, there's never any one day when each new cycle starts. So I place it currently around 2011, 2012, probably 2011 in the US. The US tends to be slightly ahead in terms of where it is in the real estate cycle compared to other countries. All of the major kind of banking and other scandals were sort of out by 2012. I suppose one landmark moment was when the president of the European Central Bank said he would do whatever it takes to save the euro. Those kind of grand pronouncements tend to be pretty good illustrative markers of key phases of the cycle. I'll come on to another one in a second. So if 2011, 2012 was the start of the present cycle, you were expecting 2019 into 2020 to be a recessionary year. And if you think that the only cause of the current recession is COVID, I think actually you'd be mistaken, because economic data was looking decidedly ropey at the end of 2019. If you look globally, I mean, there might be sort of specific local events that might suggest otherwise, but things were certainly slowing down in 2019. So we're currently here in the middle of a recession, of course, in 2020. Often at the peak of each phase of the cycle, you often get someone who tends not to know what they're talking about saying things like, we're in the middle of an economic boom, the likes of which the world has never seen before. And you've got to pay attention to these things at the current you know, in relation to the real estate cycle, because it often gives you a very good clue as to when the peak of the market is taking place. I mean, another grand pronouncement was by the chief financial officer at Bridgewater, you know, Ray Dalio's hedge fund. At Davos said, "I think the business cycle as we know it is over." So those are often very, they usually time the market, but not in the way that the person was intending to. So what typically happens at the mid-cycle recession is that you get much looser monetary policy, and you've certainly seen Jerome Powell talk about low interest rates for the foreseeable future. That engineers the recovery. There's often a massive expansion in public spending, which we're certainly seeing globally at the moment, and that kickstarts the second half of the cycle. Now, because it's not a major recession, now we can argue whether COVID is a major recession or not, but because it does not involve a collapsing land market, in my view, it's not a crisis like you get at the end of the cycle. What tends to happen is these events are relatively short to get out of, and it leads to much self-congratulation amongst policymakers as that they know how to manage the economy. And so that leads to major land boom. There's a lot of infrastructure spending typically because there's a lot of construction going on. There's a commodities boom. All of these things are coming forward in the 2020s. At some point, banks are in a fairly healthy position. It's the era of very easy money, as we saw in the 2000s in the last cycle. And as you approach the peak of the cycle, which I'm forecasting to be in the mid to late 2020s, you get the announcement of the world's tallest building. I'll come on to why that's quite important. And at the very peak, maybe there will be someone else to say, maybe another Trump saying real estate prices will never go down again. So it will be some grand pronouncement by someone saying that, you know, we've reached a permanently high plateau, all this easy money, these very high stock prices, these very high real estate prices, all of this is totally rational, totally explicable. And those things tend to be the very peak of the market. And of course, you know that you've got at least 4 years of fairly significant problems in the economy, in financial markets and so on. And the very tall building that was announced in the run up to the peak opens with no tenants, as it has in the past, as I'll come on to show. And so by the late 2029, 2030s, when I'd expect the next real estate cycle to kick off. So that, in a nutshell, is kind of the broad parameters of the real estate cycle. And just to finish on the point about the world's tallest building. So tall buildings of this nature, and this is the Burj Khalifa in Dubai, if you're not familiar with it, they rely on sort of three things. One is they rely on land prices being very high, such that kind of building high makes kind of business sense, quote unquote. Secondly, you need economic optimism, because, you know, who would conceive of this ridiculous construction when things are looking kind of ropey. And then the other thing is you need very easy bank credit, because obviously these things are inevitably financed with other people's money. And so Burj Khalifa was opened up in 2009, just when, you know, the financial crisis was really sort of taking hold. But I mean, the same thing happened in London. So this is the Shard. This is Europe's tallest building, opened up in 2010, 2011, and it was initially designed as office space, and they couldn't let any of it out as office space, so they tried to convert it into a 5-star hotel with slightly oddly shaped and sized rooms. But, you know, if you go to the East Asian financial crisis in '97, you have the Petronas Towers in Kuala Lumpur, which opened in the middle of a financial crisis. If you go one cycle before that, this is Canary Wharf in London, which opened in 1991 during the middle of a major recession. If you go the cycle before that, this is the Sears Tower in Chicago, which opened in '74 in the middle of a major financial crisis. And probably most famously of all is the Empire State Building, which opened in 1931 in the middle of the Great Depression. So there is a lot of form for this. You can go further back. I think what we'll find in 2025, 26, that you know, because now you've got the Chinese being able to construct skyscrapers in a matter of weeks. I think you're going to find something so incredibly ridiculous that it will really be a very strong sign that the peak is about to come. And so you're now forewarned. Anyway, so that's kind of the opening kind of stuff, but I'm happy to take questions on any of that or anything else you'd like to ask me about.
Absolutely. Thank you so much, Akil. I love how you said that's kind of the opening. I feel like we all just got so much smarter in that 20-minute window. So thank you. be having a little bit of a connection issue here, but it's going to power through in a moment. So thank you guys for sticking with me. All right, cool. So I've been messaging back and forth with Fletcher as we were listening to this fantastic presentation, and we're going to call an audible because we know Akil, you also, just like us, can love going down this rabbit hole. So we're going to start actually firing from the hip. We had some preset questions, and what we're going to do is turn those preset questions into a LinkedIn article, possibly on Medium or any other platform that we think is a good fit. Because Akil prepared for 7 preset questions that we had that were spectacular, and I know he's got great answers. But just like myself, just like Fletcher, and I'm sure like many of you tuned in right now, you've got some questions for Akil that are just burning. So I'll break the ice. Fletcher, you'll have question number 2. And then guys, we want to encourage you after Fletcher's question to unmute yourself and go ahead and ask. We have roughly 15 minutes left. So, we want to keep them concise as possible. And so, I'll kick things off here. Akil, I don't know why this is just coming to mind for me because I keep hearing about all of the promise in this continent. But what do you think is the relationship with the future of Africa in the current cycle? Because I feel like I keep hearing nothing, but there's so much opportunity in Africa. I know there's land available in Africa. I think the Chinese have just been slowly acquiring it all. I mean, how does Africa play a role in the global portion of the economic cycle, in your opinion?
I mean, it's going to be interesting. So I think probably for the first time we have a truly global cycle. So the main sources of growth in the global economy are now in emerging markets. And as we saw with China in the 2000s, all it needs to ignite investor interest is a good story. And Africa has got many good stories. It's got a superabundance of very fertile land. It has a very positive set of demographics, unlike most Western countries. It has a burgeoning middle class. It has increasing amounts of education, and it has a lot of inward investment. And so it's quite possible that I mentioned the world's tallest building. It's quite possible that the announcement of the world's tallest building is in a country that we're really not very familiar with. Because there's been so much excitement and investment and so on. And so I think it will play a major role. Now, probably that story won't just last one real estate cycle, probably last 2 or 3, because, there's so much opportunity. It's a very large population, but in some countries, they're starting from a fairly low base, and these things don't always happen overnight or even over the course of one cycle.
Thank you. Fletcher.
Thank you, Akil, for the presentation there. I think a lot of people right now are looking at coronavirus and, like you said, oh, this is unprecedented. To me, with all these low interest rates right now, it seems like this is just like you're describing, that we could really come out of this downturn, quote unquote, with rocket fuel propelling us to the second part of the cycle, which, like you said, is more aggressive to the upside. Is that how you see this shaping up?
Yeah, I mean, interest rates have been low for many years now, and a lot of that interest rate has basically capitalized into higher property and real estate prices and so on. And I see that thing continuing. I mean, as investors hunt for yield, there'll be more capital available for different sorts of projects, etc., and for different sort of financing. So yes, it will be the rocket fuel, but I think really the thing that we haven't spoken as much about over the last few years is how much public investment is going in globally. And that ultimately, I mean, this goes into why the real estate cycle is so important to the overall economic cycle. Ultimately the fruits of progress end up in the land market. And once you have a land boom, you really get the cycle underway. And so, governments recently have pumped trillions into the global economy. They've all committed themselves to trillions more in rail and road and other infrastructure. All of that's starting, it's coming. I mean, the Chinese have been at it for a number of years. They're taking it out to Central Asia and to other parts of the world economy through their Belt and Road Initiative. So it's all building up together to make a really, really big second half of the cycle. It's hard
Awesome.
to imagine now that we're in the middle of a coronavirus story. So, but this is why you have people like me trying to give you the longer term perspective.
Love it. All right. So we do have some good questions here, but we will pause. I know we have I could tell everyone's got their cameras turned on, ready to ask a question. So who's gonna break the ice?
Hey, Akil, how are you? This is Derek Reiner.
Hi, Derek.
So I'd like if you would take a few minutes to touch back on the time period during the two world wars and how that affected the cycle, specifically talking about the unprecedented time with what was going on in the world, but also, so I'm inclined to believe that what we see currently going on has to do more with structural problems within the financial industry. I'd specifically point to the Fed, or not the Fed funds, right? The repo market and the lack of liquidity back in September of last year, where we saw the overnight lending rate spike up to 10%.
Yeah.
So would you maybe discuss just unprecedented times and maybe what your view on, that event happening prior to COVID is?
Yeah. So, I mean, the world wars are very interesting. I mean, particularly the Second World War, I mean, this was total war. Every country was involved. The infrastructure of all of the major countries in the world was, well, at least in Europe, was totally gutted. Government control of the economy was absolute in many ways. And everything was directed towards the war effort. Now, if you get a situation like that, I mean, there's not much room for normal business activity and, the things that drive the real estate cycle, investment in infrastructure and spending and et cetera, et cetera. So if you were in a scenario like that, if we sort of tomorrow started a war with China, then I would say, yes, my forecasts probably aren't going to happen in quite the same way. But until that point, and that's the only thing that's really interrupted the cycle, you would get a repeat. Now, I suppose the question that I've then been asked is coronavirus not something similar? So far, I'd say no, because, speaking from the point of view of the UK, I know that in the US, maybe things are slightly different. We were asked to sit at home for 2 months and, economic activity kind of went down by 20%. But the difference that you have between this kind of recession and say a world war is that the moment the government said, right, start working again, we were able to do it. Whereas in the late 40s, the UK economy was in pretty bad shape because, half of London had been bombed and all the infrastructure had been destroyed and, no one had any money to spend and so on. Whereas, government support schemes and so on have kept the economy at least on ice, but in a way that, can be unfrozen at a point in time. If, of course, we have to, the pandemic gets so much worse that, we then spend the next sort of 6 years at home, then I'd say, yes, okay, the same thing might apply. Now, to your question about the repo market, I have to admit, the ins and outs of the global money markets is not something that I'm particularly an expert in. And I kind of, when I start looking into it, I kind of get slightly confused fairly quickly. I'm sure I'm not the only one. I think what we are finding, though, and it's not just this crisis, I mean, we've seen in the last sort of few years that actually I think this might be to do with accounting rules, or it might be to do with some other regulation that has come in. As soon as you get a particular problem, no one knows the location of that problem. And so the entire money market dries up almost overnight. Whereas before, you would know that bank is, not in a sound position. So you wouldn't lend to that bank, or, you would, but you would continue lending to other players in the market. I think that seems to have gone. And so it seems that the Federal Reserve has to step in with enormous amounts of liquidity every time that happens. The one thing I would say for the future, though, is if it's known to the markets, it's unlikely to be the cause of the problem. I mean, it will obviously have a bearing on the problem, but it won't be the trigger. The trigger is by definition something that we haven't thought about, and so you just have to watch out, unfortunately. But it's always there's always something at the right time of the cycle that comes along to cause the collapse. At least that's evidence from history.
Akil, I really liked, I was listening to one of your podcasts, and I think one of the most common questions you'll get you look at the history, it shows you 18 years, and people want to know why 18 years. They want like this,
Yes.
fact that you're going to break, and your answer was just, that's really long enough to forget what happened in the previous cycle. So can you kind of elaborate on why you think it is an 18-year cycle?
Yeah, well, I mean, I don't know, I can't say why it's 18 as opposed to say 20 or 15 or something. I mean, I guess, the economy is now reset at the same point, and I think 18 years is about the right time for everyone who is making decisions and one cycle may have learned the bitter lessons of the crisis, have totally moved on, such that they're not really that influential as a cohort anymore. So it seems to be that we have that kind of rhythm. And if you think about it, a lot of our careers go in 18-year chunks. We spend the first 18 years at school. Between 18 and 36, you're probably getting to sort of middle management. Between 36 and 54, you're probably getting to upper management. And when you really know what's going on, it's 54. By the next cycle, you're into your retirement. So I think there is a reason why it's 18 years in that sense. But it's probably more of an inductive theory. We've seen the evidence over many hundreds of years that it seems to follow that, and it follows the US. The US cycle is where the rest of the world basically follows the US into and out of every 18-year cycle.
Thanks, Akil. Guys, floor is open. Want to encourage you to ask your burning questions.
I had one more question related to, let's say, the data over the period of time that y'all have researched.
Yeah.
So, the Federal Reserve System that we have in the U.S. is actually the third version of the Fed. Yep. And prior to this version, it wasn't always, the U.S. dollars as it exists today, but there was competition in currencies. Banks would lend private notes. How did the study account for the different types of currency that existed, in the 1800s?
Well, in a sense, it didn't. It basically saw that these things happen almost regardless of the monetary arrangements in place. So whether the economy is on the gold standard or silver standard, or it's in a fiat system, whether it's, there's conditions of high inflation or low inflation, it seems to go regardless. Now, I think the essence of your question is this. There is always a period of very easy money right before the peak. And the issue of private banknotes by the banking system in the 19th century was the source of that enormous liquidity that drove the US economy to the peaks, and also in the UK as well. The reality is now, though, that the banking system, the private banking system, issues most of the money supply in any private economy. So when a bank lends you money, it basically creates that money into existence. And when you pay back the loan, that money is then deleted out of existence. So probably 97% of the money supply currently is private banking. It might bear the imprimatur of the Federal Reserve, but it's still bank issued money. And when banks are in fairly solvent position, they're always lobbying for easier regulations. And politicians who not to get too conspiratorial about it, it's not really this, is just the normal way of the world. Politicians that are fairly favorable to the banking system, particularly in the middle of the real estate cycle, tend to have a good chance at election. So it's, everyone has an incentive to say, okay, we've had a few years of expansion, so we can start to unwind some of the regulations that were put in place at the end of the previous cycle. And that enables banks to do what they do best, which is to lend. Unfortunately, most of it doesn't go to small businesses, it goes to the real estate market. And then you get the conditions for a major land boom and then a major land collapse, which brings down the banking system. Now, what's quite interesting, I'd say, just as an addendum to that, is this time, not only do we have private banks at the game, we've also got tech companies thinking that they wouldn't mind taking a share of the lending market. So you might find Apple mortgages being the thing that drives the peak in the present cycle, or some small challenger bank that's not had sort of history and understanding of how to prudential lending. So I think the sources of this credit might be much more diverse than we've seen before, which will just mean that the boom is even bigger than it otherwise would have been.
Yeah, I'm gonna have to take out an Apple mortgage. Should be good. We've got a few. We're getting close to the end here, but we're gonna extend it a bit. I had a question coming in from Robbie, so I want to hand it over to you, Robbie. And guys, again, please, as we move through here, don't be shy.
Yeah, sure. So, kind of piggybacking off on what you just said about elections, and you can't really go too long without talking about how this upcoming election impacts us here.
Yeah.
So what I was wondering was, we've all probably taken a glimpse of what a proposed Biden plan would look like, particularly as it relates to real estate. And it's going to, because Trump's plan was so real estate impactful. So you hear things about increasing taxes, capital gains tax, but the one that caught my eye being in real estate is 1031, right? 1031 exchange, and essentially eliminating that or really restricting it a lot. So much of passive real estate investing is in single tenant net leases, right? I mean, when in doubt, it seems like pick up a Starbucks or a QSR or a single tenant at least on a good corner and you're fine, and park your money there. So, given what Biden has proposed, or what we think he's proposing, how does that impact what I think is probably the most common investment, beyond maybe multifamily, but how does that impact the single net, lease market? Do we just see a real big run up in those, up until the election or up until a change goes into effect? And then do we see the opposite? Those just really fall off because those are transacted by folks, exiting a different investment, right? That's really where we see those buyers. So I'm kind of in that space a little bit, and it's certainly competing with folks who are making those investments, those buyers. So I'm just curious it's more of a personal curiosity, but I think when someone said why 18 years earlier, my first thought was it has to do with elections being every 4 years and kind of changing, political stances. So I'm just curious on that, and I have a second part of this question as well. Maybe after you address the first part.
Well, I don't know the ins and outs of different tax regimes in the US. I'm sorry to say, I plead ignorance. But what I would say though is, we're talking about real estate investors who are always very sensitive to changes in cost and changes in taxation and various other. In London, if you're a real estate investor, you're also quite sensitive to exchange rates because a lot of real estate capital coming into London is from overseas. Look, if one route to a particular asset within the overall real estate market is affected by the tax system, then investment money will go elsewhere. So if there's a cutoff date, I think yes, historically you do find that investors pile in and then they await what changes in tax regime will come into play. And it's probably not. I wouldn't say it's a given though. Politicians say things before elections and don't always follow through with them afterwards. But I'm afraid I can't say anything more definitive than that because I don't really know the detail. I could give you one example from London. Is like we had a major change in the tax regime for overseas investors in 2016. And that did really lead to a pretty significant drop off in interest in prime central London real estate across the board, commercial, but particularly residential. What was quite interesting was after the Brexit referendum, when the pound fell against the dollar, sort of very significantly within a matter of weeks, all of that interest, despite the fact that there wasn't a change in the tax regime, all came back because suddenly real estate from an overseas investment point of view was 20% off, 20% lower than it had been. So, it can go both ways. It's simply a matter of the kind of calculation that people have to make. And I don't know enough about that detail to know how that might play out in the next few years.
Sure. So the second part of my question is a little more broad, and you kind of touched on it right there with the example of London. So it may just be really obvious to me, but I'm looking for confirmation, but kind of migration, right, to secondary and tertiary markets. I mean, we kind of saw it a while ago, and we ended up with, the flight to the suburbs and what that entails, strip centers and suburbia housing, tract housing, things like that. But then, I'm not sure when it was, maybe call it 10, 12, 15 years ago, we saw really kind of a mass migration back to cities, right? Kind of that live, work, play phenomenon that people were really biting on. And I think, real estate prices in cities got bid up.
Yep.
But it seems like now all signs, factors point back to that migration outside of cities, COVID being the big one.
Yep.
But also, I mean, you see millennials now are at the age where they're starting to have children. It's later, but they're at that age, that 30 mark. So they're going to want more space. Then people are simply having less children. So how does that, it kind of contradicts one another? So I'm just looking for, a little bit of thoughts around that. I mean, because I am a real estate developer, and we, do you go to the suburbs, and the people come, you don't want to be kind of too far ahead of a trend, but it's almost like a trend that maybe is here to stay.
Yeah. Well, I think you probably know the answer to that question better than I do. So, I mean, and that's not necessarily a real estate cycle thing. I mean, that just depends on where the demand is, and the demand is, shaped by, where businesses are locating, where people are finding employment opportunities, and where they are in their particular life cycle. So as you say, if the biggest cohort are starting to have families, and raising families requires outdoor space, then you're unlikely to want to locate in inner city apartments. But you know the demographics. The one thing I would say from a cyclical point of view, though, and I mean, there's a lot of evidence from this in Australia and the UK. I'm not quite so familiar with the ins and outs of the US market, just because it's so much bigger. Is that what you tend to find over the course of an 18-year cycle? Is that the cycle very much starts in the biggest cities and then ripples out as prices become too high for the biggest part of the market, and then they start to ripple out to outer edges of cities, and then to secondary and tertiary cities, and often it's speculation in the smaller cities or the edge of the bigger cities that tend to be the trigger for the peak of the cycle, because as you get further out, you get to smaller places, actually the market tends to be a lot thinner, but speculators can overbuild in places. I mean, you saw huge amounts of that in Ireland and other parts of Europe in 2008, and also parts of the UK, smaller cities like around Manchester or Sunderland, places like that. So that kind of thing is a dynamic that I've seen in lots of different markets over the course cycle, but that's not necessarily directly relevant to the point that you're making, which is much more precisely about where the demographics are.
All right.
Good, thanks.
Akil, appreciate you sharing all this knowledge, man. It was a great time being a part of this, and I know Adam, he's a phenomenal guy, strong network. So I know he brings quality people on. So I want to just ask you a very simple question, just your opinion. This question kind of ties back with an earlier question back to the world wars, right? After the first Great War, it seemed like Germany just kind of printed their way out of all that debt. And it seems like it kind of started this ripple effect in macroeconomics of a lot of countries now just almost printing to oblivion whenever they have some sort of economic trouble. US, of course, being a prime example, and all that trillions and trillions of dollars that was already pumped, and now they're pumping again. Well, by the end of this month again. You mentioned, the increase in debt needs to be unwound. I thought that was very profound of you to say. Now it seems like on a global scale, everyone is printing. I mean, it's not only the US, but Europe, Asia, now even Southeast Asia, smaller countries, Japan, they're already deep in this hole.
Yeah.
your presentation made it seem like we're going to have another run for another 7-8 years. My question to you is, now that there's so much money in the market and they're planning to inject more, would that not have some sort of economic implication for a downfall sooner than that? Or do you still think it will hold true of the 18 years?
Well, I personally think it's going to hold true for the 18 years. So, I mean, that's actually quite a big question. So I'll be very brief. Look, the sovereign countries can't run out of their own money. So, and, you know, the reality is that when a government spends money, it creates the money first. It doesn't, so, you know, the US Treasury doesn't phone up Inland Revenue and say, oh, I need to spend $1 trillion. Do you have it in your bank account? Can you transfer it over to me? And so I can spend it. It doesn't work like that. The US Treasury spends $1 trillion. It creates that $1 trillion. If it then taxes the economy, it takes that $1 trillion back out again. But the two processes are functionally independent. And so theoretically, governments can print as much money as they want. The actual only limit to how far that goes is when there is idle factors of production in the economy. And, you know, all of the global economy is well below its productive capacity. So this thing isn't necessarily inflationary. The problem is that, of course, they've gone for things like quantitative easing, and that has essentially just bid up financial assets without necessarily helping the underlying economy. And so I think what we will see from all of this is an enormous bout of land and financial asset inflation that will kind of lead to major boom and then a really major problem in the late 2020s. The final point I'd make about all of that is, so when I was talking about debt need even to be unwound, that's private sector debt. That's a totally different thing. So obviously households have to maintain prudent limits on how much they borrow. And typically at the end of the cycle, you know, people have done far too much of that because the money has been available. Now, I think the effect of, and sometimes the real estate cycle comes back down to stories. What I think we have got now is firstly two things. One is that, you know, by this time next year, we'll look back on coronavirus. We'll have kind of thought, yes, we got through that. And I think that will give us a sense of confidence that our economic masters know what they're doing. And so investors will kind of jump in and they won't feel the return of the global financial crisis. The story will be about Corona, and Corona was, to a certain extent, will be painted as a success story. So that's one story that will take hold. The other story that will take hold is that actually, you know, all this debt, debt to GDP, that level doesn't really matter. And so that will enable a lot of private investors to leverage up to the hilt, which is what you need prior to the peak. And so yes, I think you're right. I still think the timing will be for an 18-year cycle, not before that.
All right. Awesome. Well, we're winding down on time. We got enough time for two more questions. I have one that was messaged in directly from Adapia Dorico. She's in LA and it's busy right now, so she can't speak, but she did send us one in. Do want to encourage everyone tuned in right now. Don't you worry. We are going to have a little bit of a breakout session after we finish recording. So if your questions don't get addressed, it's always one more chance right there. But the question from Adapia is, I want to ask about the K-shaped recovery, which is really just us seeing the starkness of inequality. How much does that factor in? Has inequality always been this big? It seems the middle class is evaporating more and more. On a going forward basis, as money moves more towards that 1% to 10%, how does that affect the cycle?
Look, big question. It's not necessarily to do, well, it is, the rising inequality is sort of, I'd say, is hardwired into the DNA of Western capitalist economies. So whoever owns assets tend to be able to acquire more of them, and whoever doesn't are reliant on wages. And if you look at the trends in asset prices versus wages, you'll see which trend is going up and which trend is pretty flat. And over time that builds and builds. Unfortunately, that kind of seems to be what happens, and it gets worse and worse with each real estate cycle, because the value of assets relative to wages is ever increasing. I mean, it did correct itself after the Second World War, but of course we had to go through the Second World War for that to be corrected. Yeah, no, I mean, I think what we're seeing in the UK, and I think this will probably be true in the US, is that governments make it their mission to get people onto the property ladder, and because property prices are going up, they're inventing lots of different schemes to enable them, which inevitably involves some form of additional leverage. So in the UK, you need to put 20% down, but you can borrow that 20%, at a low interest rate, from some government scheme, et cetera, or you might be able to borrow against your parents' housing equity, and so on. So you get schemes like that, but inevitably it involves people who are less well off taking on more debt, which then of course has problems later down the track. Sorry, was there a second part to that question? I can't remember.
I think you nailed it. We're running short on time. So one last quick question, and then we're going to close it down, guys. Free for all. Who wants it?
There was a question about war I see in the chat. I can answer that if there isn't another one.
Okay.
I'd like a follow-up. You mentioned, so it sounds like you're asserting from my previous question that the either centralization or decentralization of the essential monetary base has no bearing on this cycle because it's more psychologically driven. So I'd like to
credit driven as well, but credit always arises to drive it.
Okay. So I'd like to focus completely on, let's say, the last cycle, starting with, we saw essentially after the 01 dot-com bubble, the Federal Reserve following essentially the Keynesian macroeconomic playbook, which states, in times of recession, we lower the Fed funds rate. That essentially entices people to make investments. And then in times of prosperity, do the opposite. Essentially through open market operations, they raise the Fed funds rate, which is supposed to essentially bring us back to the general overview of how you avoid essentially the lows of a recession, but the highs of, let's say, the economy getting too hot. What we see over the last 10 years, though, is the Federal Reserve was unable to lower the Fed, was unable to raise. What we see over the last 10 years is the Federal Reserve was unable to essentially bring the Fed funds rate back to their historic target level, and we've remained at historically low interest rates. If we had a free market for money, the Cantillon effects that essentially allow people to get access to that newly created credit earlier would not exist. So would you assert that the centralization of the monetary base, of the ability to create credit, does that have an effect on this cycle? Would we see more of a mundane cycle without that? Or do you think this cycle is going to be larger because of that, essentially what I would call a misallocation of resources?
Yeah, it'll be bigger. It'll be bigger. So, the Federal Reserve is always been behind the curve. So it always takes its time to lower interest rates, and it keeps them low for too long. I mean, this is kind of the history of the Federal Reserve. But bear in mind, before the Federal Reserve existed, you had extremely violent booms and busts throughout the 19th century. So the problem is that money, however it's created, invariably ends up in the land market, and drives property speculation. That increases demand for money. Money becomes dearer. Interest rates go higher than it was. That induces other parts of the economy to go into recession because, when interest rates are artificially high because of land speculation, so it's not because of government intervention, you get a bust, and that brings down the land market, et cetera, et cetera. So this isn't really just to do with the Fed, but the Fed does, of course, put a lot of money into the markets, and that makes the booms that you get even bigger. And I think we've not only that, we've seen historically very low interest rates for the foreseeable future. We can get away with that because by certain measures of inflation, they're pretty low. For whatever reasons, I mean, technological progress is inherently deflationary. So I'm not actually that surprised that inflation has been that low. And it will create an almighty boom in the coming years. I think it's inevitable in my view. I know things look fairly grim at the moment, but it's inevitable.
Awesome. Great questions, great answers. Akil, thank you so much for investing your time with us here today. I think we all feel like we got a lot smarter a lot ahead of the curve and more confident in the direction we're heading with our careers and futures in real estate. Just want to wrap it up here, guys. You can reach out to myself at adam@carswell.io. You can reach out to Fletcher Wheaton at fletcherwheaton@gmail.com. And Akil has recommended that you reach out to him on LinkedIn or Twitter. Akil, was there another way at the end of your presentation with the slides?
There was, I get an email address. You can email me at Property Share Markets Economics. So it's info@propertysharemarketseconomics.com.
Perfect. Thank you so much. So guys, actually, you know what, before we close it out real quick, Fletcher, any closing remarks?
Appreciate the time, Akil. I second Adam. That was great and learned a ton. Thank you for your time.
You're quite welcome.
And guys, again, I just got to give even more credit to Fletcher. There's no way this would have happened or this would have taken place without him behind the scenes pushing me and encouraging us to do this and reach out to Akil. You don't even see how much of an impact Fletcher has made on this presentation coming together. So Fletcher, great co-host. Thank you so much. One more time, guys, thank you for investing your time with us today. If you enjoyed today's presentation, be sure to subscribe on whichever platform you're tuned into, especially if you're watching the replay. And to keep in touch with us and watch replay, as I mentioned, the replay video of this, as well as specific segments that we're going to take out and repurpose, follow the Next Level Mastermind company page on LinkedIn. All the content will be showing up there. We're going to have a quick breakout session here after we finish recording, but for the recording, I'm Adam Carswell, joined by Fletcher Wheaton. Presentation today was by Akhil Patel on the 18-year real estate cycle. If you didn't believe in it before, you might now. Thank you for joining us, and we'll catch you in the next presentation.